Okay, dear students, today we are doing a very great topic. Name is bad debts, bad and doubtful debts. Okay, so now before we move on, first of all, let's discuss some basics. As you all know, there are two types of sales. One is cash sales, and the other one is credit sales, right? Okay, cash sales is very simple, very easy. You just sell goods and you get the cash and then you sleep. But whenever you do credit sales, the moment you do credit sales, debtor is created in your books, and once the debtor is created in your books, that means you will have a credit risk in your books. Okay, credit risk means there is a chance that the customer won't pay. Okay, now the first thing is bad debts written off. In past you have done this bad debts written off with me in control account chapter. Now what is this bad debt written off? Whenever we get certainty, whenever we are certain that our customer won't pay us, we are sure that our customer won't pay us. For example, the customer died, or the customer left the country, or the customer is bankrupt. Okay, so if we are sure, if we are certain that the customer won't pay, then we'll book our expense, we'll book our loss. And what will be the double entry? See, the double entry will be bad debt expense debit and receivable or debtor credit, because whenever expense goes up we debit it, and because of this bad debts, now the debtor is no longer going to pay us, so we'll remove this debtor from our debtors list. Okay, so this entry you have done in past as well, and this entry is called bad debts written off. Now the second thing is recovery. Now what is recovery? Bad debts recovered or recovery means you have written off a certain debtor few days back, and now he's coming back with the cash. So once you have written off and now again the customer is coming back, so this is called recovery. Okay, so there are two cases of recovery. The first case is if recovered in the same accounting period. If recovered in the same accounting period, for example, there is an accounting period of January to December. There is accounting period of January to December, and you wrote off a one debtor in Feb, and now this guy came back in November. Okay, like from within the same accounting period. So now what will happen? See, in Feb, when you made the entry of written off, you made this entry. But now the customer came back with the cash, so that means there is no loss. So, in other words, this entry we made was incorrect. So, let's reverse it. So, at the first step, we'll reverse the above entry. Reverse means we'll make the opposite entry. So, the entry will be receivable debit and bad debt credit. Okay, so this reverse entry will give, listen my words, this reverse entry will give birth to debtor again. See, we debit the debtor, so that means the debtor is alive again. In our books. So once your debtor is alive, now this debtor is a normal debtor, and he just brought cash. Okay, so whenever any debtor, any receivable brings cash, we make very simple entry: cash debit and debtor or receivable credit. So the second entry will be cash debit and receivable or debtor credit. Okay, so my dear student, this is the first case of recovery, and the first case of recovery is if recovered in the same accounting period. Same accounting period. Okay, so whenever there is a case of same in this, if recovered in the same accounting period, you need to make these two entries which are in front of you. Okay, now my respected student, the next case is if recovered after that accounting period. For example, you make the entry for wrote off in like 2026, but after 1 year or 2 year, in 2028 your customer came back with the cash. Okay, so that means this is the case if recovered after that accounting period. That means that existing accounting period is now closed, and you were not expecting anything from this debtor, but suddenly he came up with the cash. So this is nothing but it's your other income. It is nothing but an extra benefit at the other income. So now in this case, simply treat it as other income. Now what will be the entry? See, your customer brought cash. So you will make the entry cash debit, and you know it's your other income. So income always goes, whenever income increases, it goes on the credit side. So you'll write bad debt credit. You will write bad debt. This income name is bad debt. Okay, right? So this will be the entry for if recovered after that accounting period. If recovered after that accounting period. Now my respected student, one very special thing, this second entry is the real, the second case is the real case. I would say this is the real entry. This is the real entry of bad debt recovered. The real entry which you should learn is this. Why? Because the above case, see the above case. In the above case, see these two entries. Can you see these entries? At one time we debit the receivable, and on the other time we credit. So debit receivable and credit receivable. So if you cut debit and credit same time, same side, same amount, so the remaining entry will be C, cash debit and bad debt credit, which is this C, this entry. See this entry. So I would recommend you to learn the second, the real cases if recovered after that accounting period. That is the real entry. Okay, cash debit and bad debt credit is your real entry. See. Okay, now the next stage is, I just taught you till now, I just taught you number 1 written off entry and number 2 recovery entry. Okay, now the next stage is allowance for doubtful debt. But before we move on to allowance for doubtful debt, hope you remember in past when I was teaching you inventory valuation, I taught you this concept, prudence concept. I taught you this concept which is called prudence concept, remember? And I taught you at that time, I taught you this concept gives message to expect less. This concept give message to not to overstate your financial statement, not to overstate, not to over expect. Okay, not to over expect, right? So hope you remember the 4 lines which I taught you with prudence concept. The first line was that never ever book the future income now. Income should not be recorded until it is realized. Okay, but the losses, the bad news, the losses should be booked immediately if condition exists, so that the shareholder gets alert. And the third point was assets should not be overstated and liabilities should not be understated. These 4 lines I taught you when I was teaching you inventory valuation, and you can see in the same LMS learning management system, you can see the inventory valuation chapter. Okay, you have already seen it by now. Okay, so just keep the prudence concept in mind, and the next topic you will understand within seconds. Now see, you can see a sketch. There is an accounting period of 1st January 2018. Let me write some new dates. 1st January 2027, 31st December 2027. Okay, now listen. See, this is your accounting period, and at the end of the year there is a receivable. You have receivables of 100,000. You have debtors or outstanding receivables of 100,000 at the year end. Now just use your brain. Whenever you have receivables at the year end, that means the sales already done. The credit sales already done for this. See, whenever you have receivable at the year end, for these receivable, credit sale already done. And you know, whenever you do credit sales, the moment you do credit sales, the credit risk pop up in your books. The credit risk pop up in your books. So that means you have credit risk at the year end. You have credit risk. You have a bad news at the year end. There is a chance of bad debt at the year end. So what prudence concept says, whenever there is a bad news, don't wait. Whenever you have any bad news, do not wait. Book it immediately. So what we do, receivables means there is a credit risk, the bad news is already there. So you will have to calculate that how many receivables won't pay you, how many receivables, how in from this 100,000, how many debtors won't pay you, or in other words, how many debtors will be converted into bad. Okay, so let us say we have calculated 5%. We are assuming that 5% won't pay. So 100,000 to 5% is 5,000. This is called allowance for receivable. Allowance for receivable. Okay, right? And you know the meaning of allowance itself is a judgment, estimation. Okay, so when it is an estimation, my respected student, when it is an why we are using the word allowance, because we are estimating future bad debts. Okay, right? Okay, so now according to prudence concept, what the lines of prudence concept, that losses should be booked, just repeat with me, losses should be booked immediately if condition exists, if bad news is there. So we'll book this loss of 5,000 immediately in the P&L. So it will be so there will be 5,000 expense in your P&L. 5,000 expense will be booked immediately in the P&L. Okay, right? So this is the first treatment of allowance, and then now the second treatment. See, hope you remember the 4 lines. There were 4 lines in prudence concept. The second line was this, that losses should be booked immediately if condition exists. So loss, we've just booked the loss. And then the next line was assets should not be overstated. Assets should not be overstated. So my respected student, now see, you have receivables of 1 lakh, but out of this 1 lakh there is a 5,000 doubtful debts. Doubtful 5,000 of the receivables are doubtful. So out of 1 lakh, 5,000 are bad boys. So you need to remove it. So you don't need to overstate your receivable, just show the real picture, and the real picture is this. See, your at the year end your receivables are 100,000 less. How much is the allowance is 5,000. So you will deduct it, and the net receivables on 95,000 will be posted in your SOFP. Okay, so this allowance will ultimately affect your SOFP as well as P&L. This allowance will ultimately affect your SOFP as well as your P&L. Okay, now one question as a student may come in your mind, sir, how did you calculate this 5%? How did you calculate this 5%, this thing? The answer is, first answer, this thing is not part of your course. You will get ready-made percentage, or now in latest question you will get ready-made allowance. In fact, you will get ready-made allowance. But still it's a question that how, sir, we calculate this 5% in real life. So it depends on many factors. These are the factors which I have written. Can you see? Yes, the first one is past history. If you pick any brand, all those brands which are doing credit sales, they have a credit history, they have a history of their brand. So we can calculate through our history that whenever we did $1 million sale, we get this much bad debt, then $2 million sale, this much. So with the past years we can calculate an average amount. Okay, the second thing is quality of debtor. Quality of debtor, we can say the financial health of our debtors. So if your debtors are so rich, they are extremely rich, they have a very good background, and they are like Apple company or Google company. So just think, do you think Apple or Google, they are such big giant companies, will they destroy their goodwill for few lakh dollars? No. Few $1,000s? No. So if the financial health of your debtor is very good, then you don't need to worry about much. But if your debtors are not rich, they looks doughty people, they have bad earnings this year, or their financial health is very bad, or they are about to bankrupt, in such a case you need to make more big allowance. Okay, and the third thing is aged debtor analysis. What does aged debtor analysis mean? See, this is aged debtor analysis. See, zero, let me write here. Okay, now this means 0 to 30 days it's 500,000, 31 to 60 days it's 100,000, then 61 days above. What does it mean? It means the first category is the good people. They have just recently we did credit sales to them, so since the due date they have just 15 days passed or 20 days passed, so we are not worried about this first category. We are not worried about that first category too much, but the second category is little dangerous. Why? These are the people, they are delaying and they have delayed more than 30 days and less than 60 days. In this category there are some people, they haven't paid us since 40 days or 45 days or 50 days, so they are little bit more riskier than the above category. Then the last category, they are bad people. They have not been paying since more than 2 months. More than 2 months means there is a possibility there are people who haven't paid us for 5 months, 6 months, 1 year. So this is the third case, is the worst category. So now we'll make the most highest percentage on this, we'll apply highest percentage on this, then on this, and then the lowest percentage of allowance on this first category. Okay, so this is also one of the factor in deciding the allowance percentage. Okay, right? So in practical life this is how you calculate the percentage. Okay, so my dear student, till now what we have done, I have taught you the entry for bad debts written off first, then I taught you two cases of recovery, bad debt recovery. Okay, then I taught you prudence, then I made you revise the prudence concept which we already did in the past. Then I did allowance, I launched this is the heart of this topic. Then I launched this allowance for doubtful debts. And allowance for doubtful debts, if somebody asks that which accounting concept allowance for doubtful debt is the application of, its prudence concept. So allowance for doubtful debt is the application of prudence concept. In fact, in theory questions you get this MCQ. So allowance for doubtful debts is the application of prudence concept. Okay, so we booked that credit risk which is already there in our books, so we booked it in the P&L as well as in the SOFP. Okay, using prudence concept. Now I'm writing one line. I'm writing few notes for you. The first note: when allowance is created first time, it goes directly as an expense. Whenever, see, in the above case, see, this is the first time we were making allowance in this question, so complete amount goes in the P&L. When allowance is created, see the statement: when allowance is created first time in the accounts, it goes directly in the P&L as an expense. It goes directly in the P&L as an expense. Okay, okay. Now we are doing a little activity to understand more concept, and then we'll immediately switch to the questions, practical area. Okay, so in real life, my dear student, listen to me. There are companies, normally in accounting we are studying the yearly basis, we are making P&L over the year. Okay, P&L, SOFP, everything. But in real life you will see quarterly accounting as well, half yearly accounting, quarterly. There are companies, they do quarterly reporting. Then there are companies, they do monthly reporting. and then we are assuming that we are doing daily reporting. So just assume there is an organization, they are making accounts daily, they are making accounts on daily basis. Okay, so this is the day one, this is the day one, this is the day one, and at the end of the day one, our business started now here, and this is the first day, and we have one debtor at the year end who is going to pay us 10,000. We have one debtor at the year end, let me write only 10 means 10,000. Okay, skip the 30. We have only one debtor at the year end, we just started the business, and he's going to pay us 10,000, but he's doubtful. Okay, so we made allowance on complete amount, so this is the first time we are making allowance. So complete amount will be expense, complete 10,000 will go in the PNL, complete 10,000 will go in the year day 1 PNL. Okay, right? Now what happens on the day 2? On the day 2, we have this debtor as well, the same debtor still is there, plus 2 more debtors. At the day 2 end, we have one previous existing debtor of 10,000, and now 2 more debtors of 10,000 as well. So now we have total debtor of 30,000. At the end of day 2, we have total debtor of 30,000. We have total debtor of how much? 30,000. So now what we are doing, let us say these 3 of them are doubtful, so we are making allowance on them. Complete 30,000 on them. Now use your brain. What will happen to the day 2 PNL? What will happen to the day 2 PNL when we will be making day 2 PNL for the day 2? Should we book complete 30,000 as an expense? No, because out of this 30 we have already booked 10,000. Out of this 30,000 we have already booked 10,000 in the previous day PNL. So now in the day 2 we are going to just book the movement. So for day 2 your opening allowance is 10 and closing allowance is 30. So how much is the increase in allowance? So this increase in allowance of 20,000, increase in allowance of 20,000 will go in the PNL of day 2. Increase in allowance of 20,000 will go in the PNL of day 2. Okay, why? Just think over it. Because my respected student, if we would have booked 30,000 in day 2, so 10,000 will be double count, because one debtor was same of day 1, and that for that debtor we have already booked the expense. So if we book the expense again, it will be double counted, it will overstate our expense. Okay, so now my respected student, I am going to write more things. So from this example, what new thing you have learned is, listen, the first dialogue, let me say the first dialogue. When allowance is created for the first time in the accounts, it goes directly in the PNL as an expense. For future periods, that means day 2 or month 2 or year 2, for future period, increase, listen my words, I'll write it also. For future periods, increase in allowance will be treated as an expense and decrease in allowance as an income. I will give you the logic. For future period, let me write the complete data. For future periods, increase in and decrease in allowance as an income. Now again the student will ask a question, sir, I think it's understandable that increase in allowance should be an expense because the bad news is increasing. Simple. Increase allowance is increasing means the bad news, the worst things are increasing, so it's an expense. So but why the decrease in allowance is income? So let me tell you one scenario hypothetically. Let us say in the first year I made allowance on a certain debtor X. I made allowance on a certain debtor X and I booked the expense. But what happens next year? He becomes rich and he just pays me complete amount. He just pays me complete amount. So that means whatever expense I booked last year was wrong because he paid me complete amount. So now what will happen when he'll pay me complete amount? So at the year end, his allowance balance will be zero. At the year end, of second year, there will be no more allowance on that guy. So automatically there will be some opening allowance, but the closing allowance will be less. So there will be a decrease in allowance, and that decrease in allowance will be an income. So this income will compensate that wrong expense, because in the previous year we booked a wrong expense. So definitely this year the income is justified. Okay, the reversal, you call it reversal. Okay, so let me cut down, let me tell you the summary. Whenever and you see a question of new business, and if it is the first year, so what is the dialogue? See, when allowance, see that these statements are very important. When allowance is created first time in the accounts, it goes directly in the P&L as an expense. It goes directly in the P&L as an expense for future. Okay, for the first year complete allowance is expense, but what about the future periods? Just two things you need to see. If it is an increase in allowance, then it's an expense. If it is a decrease in allowance, then it's a for sure income. Right? Okay, so if you stuck on this rules, you won't do any mistake. One more thing I would like to add. Listen, since the beginning of your education of accounting, the moment the right from the basic you have done accounting, so you know your teacher has taught you this thing, that income statement or profit and loss account we always prepare for the year. See my hand. Income statement or profit and loss account gives you the story of for the year sales, profit, everything. But SOFP is always as at. SOFP is prepared always as at, means at the end of the year, closing at the end of the year. So in the SOFP we always post closing numbers. Now see this screen. In this screen, at the end of the day too, if I ask you that what will be the closing allowance to be reported in the SOFP, so this is the amount. This is for SOFP. In SOFP you always post closing numbers. It's a year end as at thing. It's the year end as at things. Okay, so this is the question number one, the very first basic question. We'll play tuk slow, and we'll win the match. Okay, so it is written debtors at 31st December 2018 is 500,000. So this is your year-end debtors. Go slow. Company makes 10% allowance on year-end debtors. Okay, so we have how many debtors at the year-end? 500,000, and we have to make allowance of 10%. So 500,000 multiplied by 10% is 50,000. Okay, So I will teach you right now in this way. This year allowance, I'll write this year. This is the year end allowance. This year allowance means year end allowance. So we require 50,000 of the allowance at the year end. The allowance required at the year end is 50,000. Now see the question with the red pen. Can anybody of you tell me that this is the first year of business or this is the old business? First year of the business or old business? The answer is old business. See this. See, it is written existing allowance. That means already last year we have prepared some allowance. Already last year we prepared some allowance. So remember the statements which I taught you. For future periods, increase in allowance will be treated as an expense and decrease as an income. So what is the last year allowance? It's 30,000. So use your brain. Last year it was 30,000 and this year we need to make it 50. From 30 to 50 we need to go from 30 to 50. So whether it is, tell me, is it increase or decrease? Definitely increase. So we need to increase allowance by 20,000. So increase in allowance is 20,000, right? Okay, so we just calculated it. Now see the requirement number 1. Requirement number 1 says bad and doubtful debt expense for the year ended 31st December 18. What does it mean? Bad means written off. Bad means surety. Bad means certainty. Certainty means written off. So bad means written off, and doubtful debt means allowance. So written off plus allowance, report the total expense. Okay. So whenever we will see this requirement, in return we'll make this P&L box. In return we'll make this P&L box. Okay. So as this is the first question, as this was the first question, so I have not given you any written off. So I'll write like this. There is a written off of 0, no written off. Okay. But yes, in the allowance world, see the screen. In the allowance world, you have an increase in allowance. So yes, increase in allowance is your expense. Increase in allowance is your expense. So 20,000 is your expense. So 20,000 plus 0, there is no written off. Final expense to be reported in the profit and loss. Final expense to be reported in profit and loss is 20,000. Final expense to be reported in profit and loss is 20,000. Now, next thing. Now they are also asking the one SOFP extract. SOFP, I just told you, as at. See, as at means in SOFP always you write closing numbers. So how many debtors you have at the year end? I taught you this. See, I taught you this thing here. I taught you this SOFP thing already. See this. So in SOFP you have to post net receivables according to prudence. So now again in this question they are asking SOFP extract as at. So what is the as at receivables? The closing receivables are 500,000. And how much allowance? Listen to me. How much allowance you created on this closing debtor? It's 50,000. So now in the SOFP closing numbers are reported. Closing numbers as at. So your net receivables is going to be 450,000. 450,000 is your net receivable. That's the end of your first question. That's the end of your first question. Okay, next you have now for this question, I would request, just a request, pause your screen and try this question yourself and then watch my solution. Okay, same requirements, same two requirements as before. These two requirements same, bad and doubtful debt expense and then SOFP. So pause the screen and try it yourself, but I'll be doing right away. So debtors at the year end is 400,000. Company makes allowance of 5%. So 400,000 into 5% is going to be 20,000. Now tell me, this is the new business or it's an old business? It's an old business. See, so existing allowance means the last year allowance is already 28,000. Now you tell me, beginning year allowance is 28. From 28 we are going to 20. From 28 we are going to 20, so it will be a decrease in allowance of 8,000. Decrease in allowance of 8,000. Okay, right? So here you will have decrease in allowance, and you know decrease in allowance is your income. So the first requirement, bad and doubtful debt expense for the year. So there is no written off till now. I have not launched. So in the written off section you will write 0. But yes, there is a decrease in allowance, and you know decrease in allowance is income, and you know income we will record as a negative number. Expenses, the uniform of expense is a positive number, but the uniform of income is a negative number. Okay, so I'm writing a negative number for decrease in allowance, so it's going to be 8,000. Okay, so finally you will have a 8,000 income. Now my respected students, my respected students, tell me how much to be reported in the SOFP. SOFP is prepared as at, that means closing at the year end. So closing numbers will be reported. So you have a closing debtor of 400,000. Okay, and on this 400,000 only 5%, which is 20,000, is your closing total allowance. So year end allowance is 20,000. So 400 minus 20 is going to be 380,000. Okay, so one more question done. Okay, now next question. I'm going to do it myself now. Debtors at 31st December 2018 is 550. Now in the very next line it is written bad debts written off. Written off during there means already written off. This is the case 1. So you don't need to subtract this 30,000 from 550. Already means already deducted. Already entry has been made. So your year end debtor is 550. Now what they are saying, company makes 10% allowance, so you will make a 10% allowance. It's going to be 55,000 this year allowance. Okay, now tell me one thing, this is a new business or existing business? Old business. See, because it is written existing allowance, that means last year allowance is 33. Now use your common sense, tell me, is it increase or decrease? Definitely increase, because the previous year the last year allowance was 33 and this year we need 55, so we need to go from 33 to 55. So there is an increase in allowance of 22,000. Increase in allowance is 22,000, which is your expense. Okay, so now same requirements. First requirement is bad and doubtful debt. Bad means written off, doubtful means allowance. So yes, during the year, for the year. So now we have to see the full year picture. So in this year you have a 30,000 written off, and now on the allowance section, see, there is increase or decrease. Definitely increase in allowance, so that is also your expense. So 22 and 30 makes 52,000. So in the P&L you will have to report 52,000 total expense. In the P&L you need to report 52,000 total expense. Okay, now the next thing is SOFP. The next thing is SOFP. What is SOFP? In SOFP we have to report closing numbers. So what is your closing debtors? It's 550. Okay, and you don't need to deduct 30,000 from this 550 because it was already written off. Read the statement, already written off. So your year end debtor was 550,000, and how much is the closing allowance? It's 55. Simply deduct. So it's going to be 495. It's going to be 495,000. Okay, please check it out. One more question done. One more question done. Now one more question. I have, my request. Just pause the screen. Try this question yourself. Easily now you can do. It's not a difficult chapter at all. It's just number crunching. Same type of question you will see in the exam kit as well as here. Okay. So you have her debtors is 620,000, and again bad debts written off means already written off, past tense, already written off, that means already deducted. So how much is the year end allowance? It's going to be 6%. So 620,000 37,200 is your this year allowance. And now your existing allowance, previous year allowance was 45,000. Now you can tell me, from 45,000 we are going to 37,200. So yes, it's a decrease in allowance now. Decrease in allowance 7,800, and yes, decrease in allowance is your income. Decrease in allowance is your income. Okay, so now the first requirement says bad and doubtful debt. Same as before, means same requirements, bad and doubtful debts. So can you tell me how much is the written off this year? It's 50,000. So this is an expense, and in our P&L box expense sign is positive, but yes, we have one income as well, decrease in allowance. So income will be negative amount, and these two will set off each other. So 50,000 minus 7,800 is 42,200. Okay, now again you need to make SOFP, and SOFP is always as at, that means closing numbers to be posted. So closing numbers are 620,000 is your year end debtors, and what is the total amount of allowance you make on this? It's 37,200. See, be careful with SOFP. So 620,000 minus 37,200. Okay, now next thing, now you will see a little change in the question. You will have a good question now. So debtors at 31st December 18 is 430 now. And now see the see the statement, bad debts to be written off, to be written off. That means now not it's not already written off. You need to write off with your own hands. Okay? So see the magic. Now 430,000 is your year-end debtors. Less, first of all, you will write off the bad debt, and you know whenever you write off the bad debt, the double entry is bad debt debit, debtor credit, so debtor will reduce. So now you will have your outstanding, see your outstanding receivables or outstanding debtor of 400,000. Outstanding debtors means, I in my language I say alive debtors. 30,000 is died. Written off means death, died. So outstanding means alive debtors, and you know we only apply allowance percentage on alive people. Okay, we only doubt live people. We never do doubt on dead people. Just think. So now just ask this question from yourself. I have to apply 8% allowance. See, tell me, should I apply 8% on 430,000 or 400,000? Definitely on 400,000, because 30,000 is now written off. They are gone from this world. So you'll apply 8% here. It's 32,000 this year allowance. And tell me, it's a new business or existing? Yes, it's an old business. So existing allowance means last year allowance is 15. So from 15 to 32, 15,000 was last year allowance. This year we need 32. So yes, there is an increase in allowance of 17,000. There is an increase in allowance of 17,000. Okay, now requirement is same as before. The first of all, we'll make the P&L box, and this time you will be surprised some new things in the P&L box. The first thing which comes in the P&L is written off. So in this year there is a written off of 30,000. In this year there is a written off of 30,000. The second thing is, tell me the allowance. Allowance, is it decrease or increase? Is it decrease or increase? Yes, it is increase in allowance. So increase in allowance is also your expense. 17,000, one more expense. An expense has a positive sign now. And now one new thing in this question, see the yellow highlighter, this bad debts recovered. So now my dear student, whenever you see bad debt recovered in the question, just you treat it as other income. Just treat it as other income. It's an income, nothing else. So income has a negative sign. Income uniform is negative sign. So 30 plus 17, 47 minus 7 is 40,000. Okay, so that's it. This is your P&L. This is going to be your P&L. This is going to be your P&L, profit and loss account. Now last thing, SOFP. SOFP is very easy. You have to post the closing data, closing. So don't post 430 now. This is your alive. This is your alive debtors. So 400,000 is your year-end debtors. Less, how much is the closing allowance on this 8%, which is 32,000. So 400 minus 32 is, I think, 368. Yes. That's the end of this question. And what new things you learned? New thing you learned in this question. See, there are two statements. One is to be written off, and one is bad debts already written off. One is to be written off, and one is bad debts already written off. Okay, so now two things you need to be keep in mind. One case is bad debts already written off, and the second case is to be written off. Now These questions are from my workbook. It is also attached in your LMS, but you can see it here. So let's try it. These are some basic questions. Now in the question number 1, bad debts means bad debt already written off. Whenever it is written only bad debt, it means already written off. These are very basic questions. You have done it more difficult than this. So let's do it. You can pause the screen and try it. I'm doing it right away. So you have debtors at the year end 420. Bad debts already written off is 22. And yes, there is some recovery. Okay. So first they are asking, right now I'm not teaching you entries I'll do it separately, don't worry. Income statement means P&L box. In the P&L, written off is your expense. Right now in this question number 1, there is no allowance, and I taught you recovery is your income. So income has a negative sign. So 22,000 minus 4,200 is, I think, 17,800. Okay. And now in the SOFP, this year end receivable is reported, so 420,000. But yes, let me recall you that in SOFP you need to write net receivables. In the SOFP you need to write net receivables, but in this question there is no allowance, so I'm just writing receivables. Now, question number two. Debtors are 570. Now they are saying to be written off. Bad debts to be written off. So first I'll write 570, and then first I'll subtract the bad debts from this debtor. So your outstanding receivable will be 480,000. Okay. Now they are saying recovery is 15,500. So now first of all you need to make the P&L box. In the P&L box there will be a written off of 90,000. There is a recovery, which is your income. Always your income is 15,500. So this is going to be 74,500 is your net expense. One answer. And finally, in the SOFP, this thing will go. These are your receivables which will be reported in the SOFP. At the year end SOFP, this will be reported. Now question number 3. Now I am just revising with the same thing which I taught you. I'm revising it again. So debtors are 400,000, and your year-end allowance for doubtful debt is 10%. So 400,000 into 10% is 40,000 is this year allowance. Now tell me, it's a new business or old? Yes, old business. Existing allowance is 25. So last year allowance was 25,000, but this year end we need 40,000, so we need to increase the allowance by 15. Okay, so yes, increase in allowance is your expense. So this will be your only expense. There is no written off. And now how you will make SOFP, my respected students? I taught you in the SOFP you always post closing numbers. So your closing receivable is 400,000, and on these closing receivable 10% you did allowance, so 40,000 is your year end allowance. Okay, be careful with this thing. SOFP is always as at. Income statement is for the year. So your net debtor or net receivable will be 360. Your net debtor or net receivable will be 360,000. Your net debtor or net receivable will be 360,000. Now question number 4. They are saying debtors is 600,000. Again you have allowance of how much? 8%. So 600,000 into 8% is 48,000 this year allowance. And now tell me, is this a new business or old? It's old business. So your existing allowance is 55. So last year allowance is 55. This year and we need only 48. So from 55 to 48, 55 to 48. Yes, this is a decrease in allowance of 7,000. There is a decrease in allowance of 7,000, my respected students. So this 7,000 is your income, and what you will do in SOFP, tell me. SOFP is always as at. So yes, closing number 600,000 was your year-end debtors. Okay, and 600,000 into 8%, 48,000 was your year-end allowance. So 552. Yes. More questions be done. Now again do this question yourself, pause the screen, try it yourself and then watch. So debtors is 600,000, then allowance for doubtful debt is 10, and now when in the question it is written bad debt means it's my handmade question, so it means already written off. So when it is already written off, so you don't need to write it off again. So 600,000 was your year-end debtors and you'll apply 10% on it. So this year allowance is 60,000. And tell me, this is the new business or old one? This is the old business. So existing allowance is 20. So last year allowance is 20. And now from 20 we need to go to 60. From 20 we need to go to 60. So there is an increase in allowance of 40,000. Right? So now let's make the income statement P&L, this P&L box. So first of all, in this question there is a written off of how much? 15,000 is your bad debts written off. And now tell me, allowance is increasing or decrease? It's increase. So again it's an expense of 40. So for both are expenses, so 40 plus 15 is 55. Okay, now tell me, at the year end you need to make SOFP, and SOFP is always as at. So your closing receivables are 600,000. And on this 600,000 you did allowance of 10%, which is 60. Closing, all closing numbers in SOFP, always closing numbers. One more question, done. Okay, so now see this, again different wording. Now in this question it is written bad debts to be written off. In this question it is written bad debts to be written off. Again try it yourself, do it and then see my solution. So your debtors are now 560,000 and it is written bad debts to be written off. So what we'll do, to be written off means first you will write off that bad debt and then you will apply allowance percentage. So less bad debt written off, which is 60,000. So now your outstanding alive debtors are 500,000. Now you need to apply how much percentage? 10% on them. So 500,000 times 10% is 50,000, which is your this year allowance. 50,000, which is going to be your this year allowance. And then my respected students, see the existing allowance. Existing allowance is 15,000. Old question, old business. So last year allowance is 15. So just use your brain. From there was an existing allowance of 15,000 and now we are moving from 15 to 50. So yes, we need to increase it by 35. So there is an increase in allowance of 35,000. There is an increase in allowance of 35,000, right? Right. So now let's make the first of all income statement P&L box. So in the P&L you need to write first of all the written off. Written off is how much in this question? 60. So 60,000 is your written off expense. And yes, is there any decrease or increase? Yes, the allowance is increasing. So increase in allowance is again your expense. So 60 plus 35 makes 95,000 as your expense, total expense. Okay, but now in the year-end SOFP, always write the closing numbers. Always write the closing numbers. So how much debtors you need to post? 560 or 500? Definitely only 500, because out of this 560, 60,000 has been written off. So year-end debtors are 500, and how much allowance we made on it? 50, the closing allowance. $450,000 is your net debtors. Next question is question number 7. Next question is question number 7. Okay, so what they are saying, debtors is 150,000. Okay, bad debts already written off. Now the case changed. Again, the case number 1, bad debts already written off, so you don't need to write it off with your own hands. So your year-end debtors are how much? It's 150,000. And you need to apply 10% on it. 10%. So 150,000 multiplied by 10% is, this year allowance is 15,000. Okay, I'm doing it directly. 150,000 into 10% is 15,000. Now, if this is the old business, yes, last year allowance, it's 11,000. So from 11 to 15, from last year we were at 11, now we have to go to 15. So there is an increase in allowance of 4,000. Be careful with this. Okay, there is an increase in allowance of 4,000. Now my respected students, let's make the P&L box. See, first of all, how much is the written off? Yes, this year you have 10,000 is the bad debts written off. Then in the allowance section there is an increase in allowance, not decrease. So increase in allowance is again expense 4,000 we just calculated. And now my dear student, during the year, see this line, during the year, bad debt recovered, which was written off 3, so it's another income. Recovered is always your income. Recovered is always your income. So income goes as a negative sign, okay? And negative sign means bracket in accounting. So 10 plus 4 minus 4, your final answer is 10,000. Your final answer is 10,000. Now, can anybody tell me the SOFP thing? Yes, easy. 150,000 is your year-end debtors and 10% is 15. In the SOFP, year-end debtors are 150,000 and the closing allowance is 10%, which is 15. So 150,000 less 15,000 is 135,000 is your net debtors. 135,000 is your net debtors to be posted in SOFP. Net debtors to be posted in SOFP. Okay, so next question, again I would request you do it yourself first. So you have debtors of 800,000, and now they are saying bad debts to be written off. Clearly it is written to be written off. So what you will do with this case, first you will write off this bad debt. So 800 minus 45,000 is 755,000. Okay, now you'll apply the allowance percentage, which is 12%. So 755,000 into 12%. 90600. Okay, now this is your this year allowance. Now tell me, it's a new business or old? Yes, old, because last year allowance is given 95,000. So from 95,000 we are coming to 90,600. It's a decrease in allowance of 4,400. Yes, it's a decrease in allowance of 4,400. So now as a first step, what you will do, you will do P&L. You will make the packet of P&L. So how much is the written off? Can you tell me? It's 45,000. In the allowance, there is a decrease in allowance. See, there is a decrease in allowance, which is your income. So income comes as a negative number, brackets. And yes, there is one more thing. During their bad debt recovered, which was written off, see, 6 years. So there is a recovery. As well. So 7,500 is your one more income. So can you tell 45,000 minus 4,400 minus 33,100. 33,100. Next is, in SOFP you need to write closing receivables. You need to write your closing. SOFP is always as at. So can you tell me what is your closing receivable number? It's 75,500, right? It's 75, this number 75,500. Okay, now what is the closing allowance? Closing allowance is 90. Sorry, I have written one less 0. Wait. 755,500 less 90,600 is your closing allowance. Okay, so this will be 664,400. Okay, and that's the end of our today's class. I hope you liked it, you understood it. It's not a difficult topic, so you can easily do it. Okay, so thank you and take care.